Welcome back to another roundtable. My name is Adam. I have Rusmin, Victor,
Hello.
and welcome back once again.
Sorry, got the air here.
Yeah, let's do that again. Let's do it again.
Sorry.
Okay.
The air here better than the air down there.
Yeah.
Okay. Eat too much potato chip. Okay. I want to come out, but the voice to come out. Okay. Sorry.
You have a frog in your
I
throat.
want all these bloopers somewhere. Welcome back to another roundtable. My name is Adam. I have Rusmin.
Hello.
Victor.
Hi everyone.
And once again, welcome back, AK. All right. So, AK, thank you for joining us once again. It's a pleasure to always have you. And today we're going to talk about AK's Q3 dividends. All right. So I'm going to go straight to your blog post, cut to the chase. And the amount of dividends that you received just in Q3 alone this year is $84,942 Singapore dollars.
Mm-hmm.
How do you feel? All right, so just some context. This is 12% higher than the Q3 of last year. So it grew 12%, 84K in just 3 months. That's incredible, man. So
Those are just passive income.
passive income.
Yeah.
Congratulations. Yeah, that's
Thank you.
amazing. Yeah,
I
so-
think to give a better context is when we met him many years ago, around I think 2011 or 2012.
Yeah.
His passive income at that point of time was, the full year was about 100,000 plus. Right.
What's
And
plus?
105K.
105K, round it up.
Yeah,
that's round it up.
105K in 2011, 2012, right?
Yep.
And right now on the third quarter, which is your 9 month 2023, it is about what? 200,000?
Around
Around
200,000.
200,000.
Okay.
Wow, you almost double up your
Alright.
passive
Yeah.
income.
So yeah, so that means, so to just make it clear, so in 2011 it was 105K for the entire year. 9 months of this year, you have crossed 200,000
Slightly.
slightly, and Q3 alone, 3 months, July, August, September, 84K.
Yeah.
Wow, amazing. So I think the reason why we have you back here is, I mean, everyone here, I mean, they're going to be inspired by your results, right? But today we want to just have an update of your Q3, what you're doing, what you plan to do, because I think you're actually quite an active investor, despite all your passive income. You kind of manage your portfolio quite closely. And over here you say that the banks, the 3 banks in Singapore, DBS, OCBC, UOB, played a large part of your dividends in Q3.
Yes.
All right. So what are your views on the 3 banks? I mean, the short term. I know no one can predict long term. What do you think about the banks?
Well, the banks have proven themselves to be very reliable dividend payers. Yeah, so they pay dividends in good times, they pay dividends in bad times, and during the pandemic, they paid less because MAS told them to do so.
Yeah.
Otherwise, they could have paid more. So if you are investing for income like I am, I think the banks are worthwhile considerations. Yeah, and they are well managed, they are well capitalized, very well run.
Okay, what about the risks? Like, for example, I remember you saying OCBC has some China exposure.
Yeah, it's not
And-
just OCBC.
Yeah, okay.
DBS as well.
Does OCBC have the biggest exposure to China?
I think DBS and OCBC have similar levels of exposure to China, about 20 to 30% exposure to China.
So are you worried about their China exposure, for example? Like China's economy is kind of slowing down and stuff like that?
Well, we'll be worried if we don't know what they are doing, but like in the latest interview given by Mr. Piyush Gupta, right? He said that they limited their exposure to the Chinese property sector 3 or 4 years ago because they could see the problems coming, right? And OCBC in their latest results say that their NPL, their non-performing loans, actually declined, and now they are at pre-pandemic levels. So that tells us that they've been very prudent, and they have limited their exposure to the troubled Chinese property sector, which is the elephant in the room. Yeah, and unlike like the state-owned Chinese banks, right? ICBC, Bank of China, those big 4 banks, they have a lot of problem with non-performing loans, and they're actually bundling up these loans and selling them off as asset-backed securities.
That's similar to the subprime in the
Similar
US.
to mini bonds, Lehman Brothers. So because they have a lot of non-performing loans, they have to get rid of. So they are packaging them up and selling them to people who are willing to take on more risk. So, but you don't see that happening with the Singapore banks.
Okay.
Yeah.
And I think recently you also added more position in one of the banks. right? So
Yeah, just
the-
a couple of days ago, I bought a bit more of DBS.
yeah, okay. So my question is now with interest rate peaking, which is what a lot of economists are predicting, and in fact may potentially come down in the second half of next year. I don't know whether that's going to happen. Usually they get it wrong all the time, but what is your take on that? You know, if the rate started to reverse, for example, would it affect the banks?
Well, I'm not an economist,
Okay.
right? I think none of us, we are not very qualified to talk about this, but I can only say we cannot predict, but we can prepare, right? So, Mr. Piyush Gupta says that rates are likely to stay higher for longer. I mean, he probably has a better bird's eye view of things than we do. And if the rate stays higher for longer, then it will be beneficial to the banks, right? But if rates do come down, then we have to remember that the interest rates that we get for our savings and fixed deposits will come down as well.
Oh, yes.
So funding costs will also come down. Yeah, so the net interest margin should maintain, you know, if you think of it that way. But of course, the big worry, I think, that we have to be cognizant of, the big problem that we have to be cognizant of, is a slowdown in the global economy. Right, if the global economy slows down, then I think that is going to be a bigger problem, because banks being cyclical, their fortunes will follow the economy. Right, so yeah, but what you want to do is don't be overly optimistic, I always say, right? And don't FOMO, right? Just buy at any price, buy.
Yeah.
Right, so I try to use the charts to help me identify the supports, and that's what I did. I said $32 was immediate support, and if that should break 31.80, and so a couple of days ago I bought at 31.80.
Ah, I see.
But
just
just
curious-
a nibble, a nibble.
But when I look at the valuation, right? So DBS is traded above its 10 years average price to book. Then you got OCBC and UOB that is trading slightly below the 10-year average price to book. But then, why did you not think of like investing in OCBC or UOB? Is it that you have overexposure already, or?
I don't know whether overexposure or not lah. I just, everything's like how I feel lah, you know. But OCBC is already my largest investment in a
Okay.
local
Okay.
bank. My investment in OCBC alone is the same size as my investment in DBS plus UOB.
Okay.
Okay.
So I've been thinking of adding to my investment in UOB and more recently to DBS. But to your point about DBS being more expensive in terms of price to book, I changed my mind about not adding and decided to add because of its very high ROE. Yeah, so its ROE at one time was at 20 times. And OCBC was at 14 times. You know, the difference is stark. Though it's able to generate a lot of returns on shareholders' equity.
You mean
14%.
20%?
20%,
Yeah,
correct.
okay.
Yeah, sorry.
Okay.
So 20% and 14%, right? So it's a big difference. And that justifies its richer valuations.
All right.
So coming back to interest rate, maybe I could also pick your mind on, like, if the rate was to start to reverse, right? Do you think that REITs comes in to help in the aspect because they may start to enjoy lower cost of funding? So in the aspect, it's kind of like, almost like a hedging, you know, using the REITs to hedge against bank, and it can work the other way around too.
So basically, you're talking about having a barbell strategy. Yeah, so you have banks and you have REITs, which is what I have. Right, I have exposure to banks, I have exposure to REITs in about equal portion.
Okay.
But I'm very realistic about the situation we have with interest rates. REITs were doing very well because interest rates were
Low.
very low, almost zero, right? And now interest rates have gone up like 5% in 18 months. And even if you expect interest rates to be reduced next year or the following year, right? How much can they go down by? Let us say interest rates go down by 1%, 1.5%. You're still looking at 4%, 3.5% compared to 0% they were before.
Yeah.
So I kept saying that if you are investing in REITs, right, you have to be very careful. You have to look at their maturity, debt maturity. If they have to start refinancing, say, this year, next year, or the following year, right? They'll be refinancing into higher interest rates, no matter what you say. Even if interest rates to be cut, unless you say interest rates get cut by 4% next year, which
Highly unlikely.
I mean, we
Who
don't
knows?
know,
Yeah,
but it
who
looks
knows?
highly unlikely. So if it gets cut by 1%, let's say they got an interest rate of say 2%, 3% 2 years ago, and they have to refinance into an interest rate environment that's 3-4% higher.
Yeah.
Then you'll be looking at 6%, 5%, 7% kind of interest. So how is that not going to affect their performance?
Yeah.
Which is why I'm very realistic about where REITs are going, and I have a video on that about how we are seeing yield expansion in REITs. And is it time to invest in REITs because of the yield expansion? And this higher for longer interest rates environment is a huge problem that we have not seen the full effects of.
Yep.
Which is why if you have watched CNBC or some of those news, right, the talking heads on news, this rapid rise in interest rates and such substantial rise in interest rate has a lagging effect. And we have not seen the full effects yet. So when you talk about this affecting REITs, right, it's going to affect all kind of REIT assets. It's not just REITs. So for example, now you can even talk about the growth stocks, right? Growth stocks, tech stocks. Those stocks that thrive in the 0% interest rates environment. And back then they had valuations that were sky high. Now given this kind of interest rates environment, if they were to go public now, what kind of valuations would they have? So we have to be very realistic. That's why I say in my blog, any kind of investment that relies on debt in order to grow, you want to be very careful. Which is why keep an eye on the balance sheet.
Yeah. Good. Yeah.
Okay, so I mean, banks are a cornerstone of your portfolio at this time. And this is a nice segue into REITs because you were talking about REITs. And in your blog post, you were saying that IREIT Global, your decision to stay invested in IREIT Global, which is a US-based
No.
REIT, not
European.
Europe-based REIT, has not been as rewarding.
Yep.
Okay, so then that begs the question, why did you invest in IREIT Global? And why are you holding on to IREIT Global?
Well, it has not been as rewarding in recent times because the income generated reduced. I mean, of course, that's disappointing. Of course, that's disappointing. I mean, I look at my investments like my children,
Okay,
I invested time and money in my children. They grow up. Then I expect them to give me passive income. Then suddenly this child who has been giving me like, say, $1,000 every month. How come now you're only giving me $600-$700? What happened to the other $300 per month? Of course you're disappointed. What? Why this child becomes
And
like
you'd be
that?
worried, right?
I worry for myself. I don't worry for the child. But then you have to go and dig and see what's the reason, right? But before I talk about that, a bit of a backgrounder to set up the story. I like to invest in REITs, which I can tell the true value, which means zero financial engineering. Because financial engineering obscures the true value of a REIT. I don't know whether it's really worth it. So the sponsor can say, I give income support, or I waive my rights to distributions for 2 years, or maybe they sell to they bought a property, and the seller says, I will give income support for 5 years, and every year it reduces until the 5th year, then it's zero because the property is not fully leased out. That kind of financial engineering. So it makes the investment look more attractive than it is.
Yeah.
Right? So financial engineering, I don't like. So IREIT has no financial engineering. Second thing, I like to invest in REITs where the sponsors have significant amount of skin in the game. Not just a bit of skin, a lot of skin, maybe a few fingers as well. Right? And their sponsors combined, they have two sponsors. They own about 50% of the REIT. So if they do anything to hurt the REIT, they're hurting themselves, right? And I like investing in REITs, right, where the management is very conservative and they are savvy, right? So IREIT Global has a foresight of locking it fixed interest rates until the year 2026. And that was before interest rates started to rise, right? They could see it coming. And also, they refuse to use a lot of debt to drive growth. Right, so their gearing level is very low. Every time they want to buy something, right, they go back to the shareholders and say, we want to buy these things. Would you like to participate? So they have rights issue. And they rarely have any placement, if I remember, because private placement dilutes existing shareholders.
Yep.
Right? They usually go to shareholders and say, would you like to participate? So we buy these assets and how is it going to help us? They're very transparent. They're very savvy. So because of this, right, actually the REIT itself, fundamentally, there's nothing wrong. It's very strong. The problem is with the larger environment, right? The 大环境, the Chinese would say. The European economies, Germany and all that, they're not doing very well, right? And of course, the Ukraine war threw a spanner in the works. But despite all this, the REIT has done quite well, right? But of course, this is not the fault of the child. The child has suffered a pay cut. That's why it's giving you less money. But the child has done no wrong. It's not as if the child is doing drugs now or has become an alcoholic. Okay, so that's why I'm still invested in it, right? But I also explained in my blog that if we dig more into the details, right, the child that suffered a pay cut might get his pay reinstated, right? Because if you look at what they did, right, in recent months, right, they raised funds to buy a whole portfolio of out-of-town retail parks, B&M, that's leased on long-term lease to B&M. And that one, the income hasn't come in yet. It also renewed leases or found new tenants in Spain and Germany, and they are enjoying rent-free periods. Right? Usually when you find new tenants, you have a few months of rent-free period to set up shop before you start charging them rent. So that income hasn't come in yet. So these two in aggregate, once you take in, right, you can foresee that the next half, because they pay dividend twice a year, so it's half yearly, the next dividend payout should be higher. So there will be some kind of recovery, right? And also, IREIT Global is actually very undervalued. It's very undervalued. And it's not just by the usual metrics of book value and all that kind of thing. But of course, that's something that's very easy to use. They actually extended the lease of their Berlin asset, which is, I believe, their crown jewel, by 6 months at a 45% higher rental rate. So that proves my suspicion, or many people's suspicion for a long time, that the Berlin asset has been under-rented for too long. Because the contract was signed years ago when the rental rates were very low. And that also proved another point, and that is the work from home culture isn't as strong in Europe compared to US, where the rental rates were just dropping. But they were able to renew it at a 45% higher rental rate.
And now, the Berlin property, right, how much does it comprise of the whole portfolio?
I think it contributes to 20% of their income.
So it's quite a bit of a boost.
Yes,
for that one property.
But again, I want to be realistic.
Yeah.
Because it's only a 6 months extension. And from what we know is that after that, the tenant's going to vacate the property. But that also fits into IREIT's overall plan of rejuvenating the property, because it's freehold, it's quite old. So they want to bring it up to date. So they update the looks, update the building. So that's going to take about a year of renovation. So for 1 year, you might not have any income from that property. So I can imagine Mr. Market becoming pessimistic again when that happens, which is why I produced a video on what kind of price I think might be trading at that time. And at that price, I'll buy more.
All right. So you're happy to wait.
And I'm happy to buy more.
Okay, yeah.
And they're going to lose 20% of the income?
And then if the 20% drop in the unit price, right, you have to ask yourself, if something impacts a certain investment negatively, is it temporary or is it permanent? If it's temporary, it's an opportunity.
And also this is the fact that you are comfortable owning European assets, right? Because not everyone's comfortable with it. I mean, I'm one of them actually, because I look at the European asset, I'm not familiar with them. So so this is basically the kind of risk appetite that you can actually are willing to take, I would say.
To be honest, I hold so many REITs, and I can tell you I'm not familiar with any of their assets.
Okay.
It's not just IREIT. Do you think I go and visit every one of AIM's APAC REITs properties? No.
Not possible. Actually.
Not possible.
But it's too much work.
I was invited by the CEO many years ago to do a tour of their properties in the West. I have a blog on that. And then I had a look on, and then he shared with me some of the plans, and I blogged and shared with my readers. But those opportunities are very rare. I'm just a small retail investor, and I'm just that I'm a retail investor plus blogger, right? And then of course I cannot go and visit their properties in Australia, right? So I think this thing about investing in REITs, you want to invest in REITs where the buildings you can touch, you can see. I think that is very uncle lah. I mean, I'm uncle lah, but not that uncle.
So you're saying I'm uncle?
You are more uncle than me, I think maybe. Because you see, for example, like Land Lease Global, right? Land Lease Global. So you can go and see GEM, for example.
Yeah.
But you can go and see their property in Italy.
There's an excuse to go to Italy now.
Go to Italy and go and see their
I'm
property.
going to Milan. I'm going to Milan.
So it's the same. But you know, when I invest in REITs, right? A classic example in my case is Saizen REIT.
Oh yes.
100% of their property in Japan.
Japan.
And not only that, in Japan they have more than 100 buildings. I think you can see all the buildings.
Time to take a trip, man. Take a train.
Yeah. So sometimes you have to see what is realistic for you to do.
Maybe the main thing is like that could take care by yourself if it's just if they have a diversified portfolio. That's one that can actually kind of reduce the risk. Second would be like there's a currency risk, right? I think increasingly I see a lot of investors are not willing to take on currency risk. Well, the fact that I think Sing dollar has been strengthening against a lot of emerging currency, so that could potentially be a risk also for. I mean, some people may not be willing to take that risk, and you are comfortable with it.
Well, the Sing dollar is very strong.
Yes,
that's for sure.
Which is we are all happy, right?
No. It's a double.
I'm happy.
No, it's a double-edged sword.
Yeah.
It's a double-edged sword. You talk to exporters, they are not happy.
Oh yeah.
Yeah. So you talk about businesses, they are running in Singapore that relies on exporting to make money. They are not happy. They are finding themselves being less competitive.
But you're not investing in those companies.
No,
right?
no. Those companies are renting properties in Singapore. Those companies are renting properties in Singapore, so they are the people who are generating rental income for the REITs with properties in Singapore. So if they're not doing well and the REITs keep increasing the rent, because they have to, because the interest rates are going up, how are they going to stomach it? So there'll come a point that MAS will be caught between a rock and a hard place. Let the Sing dollars stay strong or let it depreciate a bit. I think we have to be realistic about that. That's why I say we must know that we don't know what we don't know.
You can't do that.
We must know that
you must know what you don't know.
We must know that we don't know. We must know that we don't know what we don't know.
Okay.
Yeah. We must know that we don't know. There are too many things that we don't know. So based on what we know, we try to make the best decisions.
Okay. So IREIT is just one of your positions. I don't think it contributes a whole lot of your portfolio in any case, right?
IREIT and AA REIT together, they are smaller than my investment in the three banks.
Yeah.
But they are quite substantial.
Okay.
Yeah.
All right. So it's something that you still need to watch out quite diligently over the next 6 months to a year, since this Berlin property thing and the tenants are
I like to
leaving and stuff like
invest.
that.
I like to invest in businesses that I don't have to worry too much about.
Okay. And
these are the businesses I don't have to worry too much about. I mean, there are many people who are worried about IREIT, but they are worried about the price.
And for you, the price is the opportunity.
I'm not worried about the price because I'm not looking to liquidate in order to get money out of it.
Yeah. Okay. Yeah, I think there was a comment or question about IREIT. So I hope that, the insight from you was useful for, those who were asking about IREIT. So specifically, let's move.
Before that, don't suka buy.
Yeah, so no recommendation buy or sell anything.
I've highlighted a few risks that you need to consider. Because AK is willing to take on that risk. You may not, so you need to ask yourself.
I mean, he got a long-term perspective on this REIT, right? In the event where the 20% gross income is going to disappear,
he's prepared for that.
He's prepared for the drop in share price.
And he wants to buy more.
He wants to buy more, right? But how many of you can actually do that? Not a lot of people can do that, right?
So you be very clear about your investments, which is what you are.
Yes.
Most of the time, right? So I think when it comes to investments, it's very personal. So that was just AK's insights. Take what you want out of that. But let's move on to another part of your blog post, which is saying that you can't predict what's going to happen in the market, which is true. Yeah. So in the meantime, like you said, we can't predict, you prepare. So you're building up your war chest, right? So 84,000 in dividends. does that all go into your war chest, or do you spend some of it? Or, I think some people were asking that question. Some of them may have substantial dividends for themselves. Maybe they're making 10K a year or something like that. And you don't spend all of it. You try to put aside some and reinvest your dividends to grow your portfolio. So for you personally, how do you build up this war chest? How much do you spend? How much do you keep?
I used to keep a lot of the money.
Yeah.
During the days when I still had a job. Right. So
that was 8 years ago.
Before 8 years ago, when I still had a job, I didn't have to spend my passive income. I mean, the passive income were mostly just used for reinvestment. Yeah, but ever since becoming a retiree, right, no earned income, so I have to live off my passive income.
So you live off your passive income, and your passive income still grow. So
yeah,
that's the amazing thing, right?
So that means if you have not lived off your passive income, the amount should be higher.
Even higher.
Yeah. So I decided enough is enough lah. I didn't want to continue exchanging my time and energy for money. I want to have more time to do my own things I enjoy. So I don't want to be caught in a situation where I have too much money and too little time.
Yeah.
Retire at 75 with millions of dollars and not much time left to enjoy my life.
Yeah. So what's the percentage that you are keeping for your war chest?
Well, now it's very little. I have a blog post that says I need about $48,000 a year for myself. And I want to put aside $48,000 for parental support. And I still want to do voluntary contribution to my CPF at that time. So not the voluntary contribution portion has changed to Singapore savings bonds, but the amount of money set aside is still the same, which is about $38,000. So if we take all this out, right, that's about 140K. And then the balance can go into my war chest.
Okay.
Yeah, but that's me. Everyone's circumstances would be different. But this brings up something in my mind. That's why I keep telling people, try not to go for lean fire. I mean, it's up to people. Because lean fire, basically, you just achieve just nice, I can retire early. But then, if you do that, then, something happens, your expenses goes
buffer
up.
Yeah.
No buffer. So that, for me, I very kiasu, I very kiasi. So I work very hard. I build a big buffer. Then I always thought, what if I don't have enough? Why don't I have enough? So I always worry. I'm a born worrier.
Do you still have that mindset?
I still worry, but it's very hard not to worry for me because it's a psychological issue.
Okay.
Yeah, because scarred from young. But nowadays I try to be more easygoing with money. And to realize that actually I do have enough.
Okay.
I do have enough.
I think a lot of people will think that you do have more than enough. I mean, the facts bear out for itself. You retired 8 years ago. Your 2011 dividend was 105K annually. Now it's over 200K. So even without working for 8 years, it's grown. Like Victor said, it has doubled in that amount of time.
Yeah, because Victor said I'm very siap ma. Yeah, so
it's a known fact, right? I think all your readers know it's a known fact.
Please don't share my old stories. I know you're trying to remind me of what happened in the
Let me ask you a
past.
question. What's the difference between frugal and stingy?
Stingy is when you really, every single cent, don't spend. Even if you have to spend, you don't spend.
Okay.
Being frugal, if when it's necessary to spend, you will spend. So, for example, I see a dentist.
Okay.
If you're stingy, you won't see a dentist. I'm frugal, but I realize dental health is important, so I see a dentist.
Okay.
But I go to a polyclinic to see a dentist.
Okay.
Scaling and polishing, $50. If I go to a private dentist, $120. So it's about value for money. It's not about affordability.
All right. My definition for stingy versus frugal is you are frugal when you're careful with money for yourself. You take care of your expenses. You're stingy when you're very careful with money when it comes to others. Like you don't want to spend for others. Like for your friends or your family and stuff like that. You're like, nah, I'm not going to spend that on you.
Oh, no. Then I'm not stingy. I always buy snacks for Victor.
That's my definition.
Definitely not
That's my
stingy.
definition anyway. But okay, so you do set aside quite a bit for your war chest. I mean, that's going to grow. And if you're going to continue to invest, which I see you doing for the next 20 years, I mean, all the way to the end, it's going to grow even some more, right? It's going to be, you're going to be fine.
I hope to die penniless.
That is not being stingy. That's pretty good. Yeah.
Yeah.
You can give it away, right?
Yeah, I plan to set up name bursaries
Ah,
before my
nice.
death and help
Nice,
needy
okay.
students.
Okay.
I mean, that's what I'm doing now as
Mm.
well by through direct donations.
Okay, that's good to know actually.
Yeah.
I
Yeah.
don't think you advertise that fact, but I think if this is the first time you're sharing it, I think it's
I've blogged about it before,
okay.
and I've blogged about how NUS sent me an invitation to join their dinner to thank
Okay.
the donors, but have to be smart casual lah. AK never drives smart casual.
it looks pretty smart. Smart casual enough.
You wear like this over
You can wear
there.
your mask there as well.
Yeah, so I didn't
Yeah.
go.
Yeah, look like some kung fu master.
Yeah.
Yeah.
Sifu.
Okay. All right. So I mean, that's pretty much in your Q3 blog post, which I think is a good update. Because every quarter you would do this. So for those who are interested, to read more about your updates, just go to your blog at ASSI. You can just Google that, a Singaporean stocks investor, at blogspot.com.
Go to my YouTube channel,
YouTube channel as well. So what is your YouTube channel's name?
AK71SG.
Yeah. Okay.
Plain vanilla.
Okay, so do check if you want more constant updates from AK. But we love to have you here because then you get to we get to chat with you, find out more, pick your brain a little bit because we all can learn
Yeah.
from you as well.
Yeah.
Oh no.
I've been learning
A
from you
lot of
for
things.
No.
10 years already.
No,
No, you can learn from us as well. It's a two-way thing.
No.
I teach you how to
Nothing
spend
to learn
money.
from me.
Okay.
Nothing to learn from me.
Yeah.
Rusmin say one AK no substance, never mind. Funny can already.
It's so funny that Rusmin said this many years ago.
I can't even remember I said that.
He said that during
He
the.
just went like a dagger to his heart.
Yeah,
So mean,
It's like
Rusmin.
every single year he will say that.
No, what I
right?
meant was that he's a funny person. Actually.
Yeah.
That
So
was during the
I-
first Invest X Congress.
Yes, and a lot of people liked it, like you, because
Yeah.
you are a funny
Oh,
person.
when is
Yeah.
the next Invest
telling
X
the truth,
I
Congress?
don't know, man. I mean, I don't know what they want to do.
I don't know, yeah.
Big
Yeah.
physical events is like so much work to do.
Yeah.
So anyway, I mean, we love having you back here again.
Thank you.
And I think our viewers like having you around as well. I mean, a lot
Thank
of
you,
comments.
thank you.
So is there any other questions you want to ask, AK?
How are you going to distribute your income?
Is my
Yeah,
name
can
on
we
the
be-
list?
can we
Is
be
my
part
name-
of
is my
this?
name
You
on
are
the
not
list?
needy students.
That is true. I don't need it.
Yes, exactly.
True.
Yeah.
So thank you once again, AK, for having us. That's pretty much it. My name is Adam, Rusmin, Victor,
you.
Thank
and
you.
of course AK.
Bye bye.
All right. So if you like this roundtable, please hit the like button. Tell us you're doing a great job. Any questions, put them in the comment section, and then anything we can ask you as well, if it's a relevant question. And of course, subscribe to our channel. Many more roundtables coming up, and we'll see you again.